Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Lululemon Athletica stock, ticker LULU. This one came in by request from several different people. I have covered it in the past, but I'm going to look at it kind of a different way this time. I recently went through, this one's been kind of hovering around a potential buying area. The metrics have kind of almost aligned a couple different times, and I haven't pulled the trigger. And so this weekend I went in and thought about it a little bit more about how I want to approach it, and I'm going to make a video on it today. As always, not individual investing advice, just how I analyze stocks. All right, so Lululemon. Let's start by looking at the historical earnings pattern, which is really good. So earnings most of the time, other than a short period in COVID, have been moving pretty much up and to the right. A little bit of stagnation here in the 20 teens. And then this year looks like it's probably going to be a slightly negative year for earnings growth. So the stock it looks like it's plenty high quality. If you bought down here, like you're like I don't know, however many, it's like 100 bagger or something. It's crazy. So they've had a lot of growth definitely off the recession bottom back here. And I don't know how comparable. One of the things I was looking at is I had kind of recession metrics set up for it, but I was using either 2020 or this last year, 2020. I was using one of these closer time periods because it fell so deeply during the Great Recession. It had only been public for like a year. Nobody knew that it was going to kind of blow up and grow as much as it did. So I don't think this tiny company that is 1/100th of the size that it is now is comparable to whatever the next recession might look like. But I also don't think necessarily that these recent patterns are good to use either. Or the best anyway. They've worked so far to keep me from buying the stock too soon. But maybe not the best guide. So I was trying to figure out, what's the best way to like think about this stock and get some metrics in place. I like to usually be watching stocks ahead of time, know what I want to see from them metrics wise before I buy them. Like, it's pretty rare for me just to wander. Well, I kind of always know what I'm looking for, but I like to do that kind of work ahead of time so I know what I want, and I'm just waiting on the stock price, or I'm waiting on the momentum or something like that, or I'm waiting on whatever they need to do, rather than have like some story I read somewhere lead me to it, and then I already have that story kind of influencing my judgment. So that's kind of what I'm doing here. I'm trying to think, okay, what do I want to see in the future? What would it take for me to buy this stock and hopefully get good returns over the medium and long term? And it's been successful, and it's traded off. It's very deeply down, especially relative to the market. So holding off buying it has been the right decision during this time. I'll give myself credit for that. It's a $25 billion luxury apparel. I don't even know if it's luxury. I guess it's a little bit more high end. Kind of known for its athleisure type things like yoga pants and things like that. I don't own any Lululemon stuff that I know of, so I can't speak from personal experience, but that's what they tell me. So that all looks pretty good, and the question is, well, why is this getting creamed so much here? We're down at a 13 PE almost, or at least under a 14 PE ratio. On a stock that has historically grown 30%. Well, let's 30% per year. That's their earnings. If we shorten the time frame on the fast graph, I'm going to use some different things on the fast graph this time that I haven't used before. Some features that they've added. I do have a 25% off affiliate link down in the description. I'm not sponsored by them or anything. And I use fast graphs way before I had this YouTube channel. But what I want to do is shorten this time frame, and we can see what kind of growth rate we've had over this time period. That's more like 20%. It's still huge, right? I mean, if they could grow earnings 20% a year from here for the next 10 years or whatever, it would be a steal at this price. So the question is, how much do we really usually I use historical earnings to help guide the future. So normally I would look at something like 20% growth and I would say, okay, what's if they are able to do that, then maybe they can keep doing that. But you also have to look at what business they're in. They're in a difficult retail business that is traditionally can be up and down, especially once you reach a certain size. So when we start asking ourselves, what kind of earnings growth rate can they really pull off in the future? I can look at what analysts are thinking. They're thinking no growth this year, 8% 2027, 4% 2028. So now they're thinking low single digits, and that corresponds to this low PE ratio. So that's kind of where that's all coming from, what analysts are expecting going forward. And they've had a big run here. And they haven't had so this is definitely part of a COVID boom in terms of stimulus money and all that stuff and people getting back out in the public. But they haven't really had a bust yet. So that's been kind of delayed, unlike a lot of businesses. So that could be some risk to the downside over the near term, just a reorientation. We shouldn't really, I wonder what they did. Maybe it's more realistic to look from let's look from 2014 to pre-pandemic and see what it looks like. So when we change the time, I haven't done this yet. So this is more like 15% growth during this period. 1, 2, 3, 4, 5, 6, 7. So a pretty good run of 7 years. Slower growth there. And the stock price was trading at 48 PE. People are very optimistic about that. It might be a good lesson here on not to pay too much. So if you were willing to pay that 48 PE, you're now down 2.5% a year with 3% inflation or 4% inflation a year. And that's what happens when you overpay for stocks sometimes. So when I zoom out, I think, okay, let's look at the big picture. They probably can't grow at the rate that they did before. Okay, they're already big. They've already grown gigantic for their industry. Already in the S&P 500. And so now the question is, what's a reasonable earnings growth rate to like attach to these guys? So, I mean, and what I mean by, I want to kind of look at this business life cycle chart real quick. So I just made this up I kind of copied it from Professor Damodaran. Not all the interior stuff, but the basic structure of it. So this is kind of what a successful company's long-term average earnings will look like. So first they'll be unprofitable, then maybe they'll go public and become profitable after their IPO, and then they have really fast growth, and then it slows down, and then it kind of stagnates, and then it shrinks, and then it declines into nowhere. So these little stages can last any amount of time period. They aren't evenly spaced like I show them here. But it's worth thinking about, okay, there's going to be a period where a business is growing at 15% a year plus, growing earnings, right, during this stage. And then, but that's not going to last forever. So we have to ask ourselves, where do we think Lulu is in this cycle, okay? For me, I think they're kind of probably, and this is all just guessing, nobody knows, but the market's even going to be a little bit more negative than me, I think. I would say, if I had to guess, they're in kind of this zone, the later part of the steady growth phase. Taking into account that there can be undulations in this retail apparel world, okay? So you can have a couple of down years, then you can have a hot product or something that catches on, and that can bring you back. And so to me, like, this is kind of where we're at. The market seems to think we're more here, like in the mature, no growth, potentially worried that they're going to tip into decline. Now, if they have earnings decline for a year or even 2 years, the market will start pricing it like it's going out of business, which is what it's starting to. It's not there yet, but it's starting to do that now. So I'm more optimistic than the market. I think they could, and you don't know what's going to work for them in the future, but I haven't seen signs that like anything's like horrible fundamentally with them. And so if they keep, doing their job and coming out with new products and marketing them well and all that stuff, then I think they can grow earnings at maybe like 7% a year. And you got to remember 3% of that's probably going to be inflation. So really only growing at like 4% real, which I would put at the end of this kind of steady growth phase. Kind of this is where we are. Somebody else might think differently. Now, most of the people that are looking at this, if they're looking at the past and extrapolating it out, which is what I often do, they might think that they could grow 20% or 15% or something like that, in which case they would be back here in this phase and have much more room to grow, and the stock would be like a steal here. And I'm sure lots of people on the internet are thinking that. I'm not that optimistic. There's only, for a apparel business like this, it doesn't mean they can't grow bigger, but they're already really big, and it becomes more difficult to grow at earnings at a fast rate over a long period of time, and you're paying for future earnings. So for me, when I zoom out and kind of take a deep breath, I know the history was good up to here, but I kind of think we're probably more probabilities are we're in a situation toward the end of that steady growth phase. Now, what makes things difficult is when we toss in the potential of a recession or something like that, even if it's just an industry type recession, the downside could still be pretty big. So the one I'm going to show here today doesn't assume there will be a recession. This is kind of without that, what I would be looking at going forward here. Let me make sure I pull up the right thing. Yep, there we go. Okay. So the idea here is I think they can grow earnings at 7%. And I want to know what type of CAGR I would get using just their earnings over a 10-year time period on average. If I just collected all their earnings, those earnings grew. If I owned the business, I collected the earnings. Those earnings grew at 7% a year. What sort of earnings CAGR would I get? And it would be 7.62%. So usually you're using this method. I want this to be about 8% before I buy, which means the stock price needs to go lower. Because as the stock price goes lower, you're buying more earnings with each dollar that you put into the company. And that buy price would be about $186.50. So only about 6.5% lower than where it is right now. I'm not going to go through the whole thing explaining this right now because it's not the most important thing. You can kind of look at it and just see that it looks, it's only a 13 PE. So the question is, we know what that is. The question is, what are earnings going to do going forward from here? That is really the question you have to ask yourself. For a medium-term investor, I'm not trading this. This is 3 to 5 years, potentially longer into the future. So one of the cool things you can do on FastGraph that I haven't really toyed around with until today was, so FastGraph started doing this thing where the fair value ratio will change based on the earnings growth. So this is like, well, let's back it up, and if I go longer frame, you'll see the difference here. So over this period of time, they grew earnings at 30%. So they put that fair value ratio at a 30 PE, which is what is relative to the earnings growth. That makes sense, but it used to be in the old days, the custom value rate or the fair value ratio was always 15. But the problem is we've had so many growth companies that never looked like buys. They changed it, I think, so it adjusts now. If it's a slow growth company, it'll be 15. If it's more than like an 18% earnings growth, the PE on the fair value will match that. So that's a 30.15 PE. So it makes the stock look super cheap if you think they're going to grow earnings 30%, which I don't per year, like going forward for a long time. But if I put the 15 in, which is the way it used to be right here, then it doesn't look quite so undervalued, right? And what you can do is you can go, since I've added this in, you can also go to the forecasting section, and you can also customize that so that, let me see if I don't have it customized. So you can go into custom, and then what I did was I took that 7% earnings growth I was talking about, and I just typed it in. to it's like up here somewhere. You like enter it and then you hit it. So I already did this earlier. So now we can see, okay, what would this look like if they do grow earnings 7% a year for the next 1, 2, 3, 4, 5. You can look 5 years out, which is kind of the time frame that I'm usually using. See if we can do that. So we can, so we can go over here. So at a 15 PE, which is not really demanding if they're growing earnings 7% a year, you think that's probably a little cheap given today's market. You could get a 9.5% CAGR over 5 years. So that's really good. At a 16.5 PE, let me move my head out of the way. You could get 11, and that's probably kind of the base case of where, you buy it like a little bit lower than here at my buy price, and they grow 7% a year perpetually for 10 years is kind of what I was modeling out. The stock price will revert a little bit based on that once they've kind of established that new earnings growth rate and the market isn't worried about earnings falling, which is what's happening now. You could get an 11 to 12% CAGR. And then if the market got a little happy, like some good news came out, and maybe you get up to an 18, now you're looking at 13%. And that's pretty reasonable. And so that would be kind of the scenario where my 186.5 buy price would be kind of what the thinking behind it would be. Now, the big question is, what does a recession look like for these guys? And for me, I don't know. So I've been on the cautious side. I think it could go even lower. If that earnings growth really turns negative, the market could even get more negative on it. So I also right now want to see positive momentum in the stock price. I basically want it below my buy price, and I want it to have some signs of recovery. And if both those things happen, there's a good chance I could get like a pretty good return on it. But it's kind of a little bit more cautious because I do think recession risk is high. But if a person didn't think that, then I think that 186.5 buy price would be fine. You could also take a position at that point, like half a position, and then wait to see what happens over the next 6-12 months or something. And if the macro is what the problem is, then it will probably eventually recover. So it would be worth buying it at another price. It wouldn't be anything specific necessarily to their business. That would just be like a macro thing, but you want to still buy it when it's cheaper, right? If you can. So that's like the big question mark to me. So I think, nibbling at that 186.5 with the optimistic view, and then waiting to see what happens on the macro if it gets worse. Now, while you're waiting for it to fall, if the macro falls apart, then you can just wait until the momentum, until it forms a bottom and starts to come up. Now, you're not going to pick the bottom in a situation like that. But as you've seen from the people that have been buying it for the past 1, 2, 3, 4, 5 years that are all underwater right now, being patient when things get a little sketchy on businesses like this in particular is a good idea. All right, I think that's all I have for this one. If you have any questions, put them down in the comments and I'll get them answered. If you have any requests, let me know. I'll put them on the chalkboard behind me. I have a free tier over on Patreon where I post a lot of videos too, so make sure to check out that link. And I have weekly picks where I select whatever the best stock I can find in the market that week. I share with everybody. It is possible Lulu could be one of those if it's the best thing that I can find. Everything's pretty expensive right now, although we're selling off a little bit today. Maybe I'll be able to get some deals. For those who think I never buy anything, I find something every week, and that's $25 a month over on Patreon. Thanks for watching, everybody. I'll see you later.